Thank you, Prem, for inviting me here. It's an honor and a privilege. So I think I was hearing with a lot of interest what was spoken about India. So let me give you my perspective of India. I think India is a very diverse, uh, it's a country which you cannot fit in a framework. And whatever you say about India, the opposite is also true. You can be highly appreciative of India, its strengths, its diversity, and you can be extremely critical as well. But what you cannot deny is the progress which India is making, and in many aspects, and especially in terms of the economic performance. This is a very simple slide. And it was said in the previous that habits don't change, so my slides, I can assure you, they go back 30 years. Only the data keeps on getting updated. So look at this slide. It presents to you the decadal growth of India in real terms and in terms of nominal terms. The blue bars is the decadal growth over last 45 years, and the orange bars on top is the decadal inflation. And the columns at the bottom have the key events that have taken place over this 45 years. And what you see is something really remarkable, really simple, but very powerful. No matter what, India has grown. It has grown between 5 to 6%. And the strength of India you can appreciate from one simple observation. In the year of Lehman crisis, when the world was on a very weak ground, India grew 5.5%. So that is what India brings on the table. The fall in inflation has been very structural in India. In fact, once the RBI started the flexible inflation targeting framework, the volatility of India's inflation is one of the lowest in the world. And that is why we are expecting significant decline in inflation in expectations, and also a sustainable decline in the cost of capital. So why does India grow? I mean, what is unique about India despite so many negative headlines, negative views that you keep on hearing about India? Why does India grow this way? See, I think the answers are very simple. Focus on the box in the middle. India is a great demographics. China is aging now. Europe is aging. Japan has been aging. India continues to grow till 2050. The number of young people in India will continue to grow. Not just that, India offers you a very stable socio-economic political stability. I mean, we have not seen any governments being overthrown. There are organized crime is extremely less in India. Someone spoke about in Argentina moving in armored cars. You don't need to do that in India. So India has huge natural resources. Apart from oil, I think practically everything is there. And we have something better than oil, which is sunlight. India's solar power will be one of the cheapest in the world. And the day storage becomes cheaper, and we should get there in 3 to 5 years' time, India will have a shot at becoming current account surplus. And the world can change for India. Imagine India without oil imports or with much lower oil imports. Instead of a depreciating currency, you may have to struggle with a appreciating currency, which will pose its own challenges. India has one of the best human resources in the world. And I heard that don't be middle class. Well, India owes its talent to middle class mentalities. And I have known almost all the families in the country closely, and I see what middle class gives to the world, the human values, the desire for excellence. I don't think it is there in the upper classes at all. So I think I would proudly say I bring middle class values on the table. And that is what makes India tick. If you look at all the global leaders in US, they are from middle class backgrounds. Hardly anyone is from one of the Fortune 100, 500 families. So I don't think we need to be apologetic or on that at all. And we should worry about, on the other hand, if we lose these middle class values, then this huge talent pool that we are creating for the world will not be able to do it. India has some very extremely bright entrepreneurs, and now we have an extremely supportive government. So people often compare India with China, Vietnam, Middle East, various other countries in the world. If you do that, you will not get the right understanding, right perspective of India. Look at India, compare it with its own past. Look at what India was in 1980, 1990, 2010, 20, 30. If you look at India every 10 years, you will not be disappointed. So that is how I look at India. And India always changes in crisis. So every crisis is welcome in India, because in a democracy, in a federal setup, when you have free media, free judiciary, independent media, federal government, state governments, local governments, change is always slow. But the good news in India is that there is no reverse change. Look at government standards, leadership standards all across the world. So I think India offers a lot of stability, and look at the chart at the bottom. That is the volatility of GDP growth of various countries. India has one of the lowest volatility in economic growth rates. And that is something which I think is extremely positive, and it's a key strength of India. I think India is facing, I've been in these markets for 35 years, and I feel the most optimistic when I look at the next 10 years. And why do I say that? Many things are known about India. I mean, our infrastructure has improved. India has adopted digital like very few countries in the world have done. Our infrastructure has improved. Of course, cities in India are extremely crowded, and that will remain like that. So don't look at the crowded cities of Bombay, Delhi, Calcutta and start judging India. I mean, Mumbai has 30 million people. It is maybe 0.4% of the world's population and maybe 2% of India's population in 3 by 50 square kilometers. So that is the reality of India. That gives a lot of advantages, but it does pose challenges in the quality of life in Indian cities. But why do I feel very optimistic about the economy? There are two things which are changing in India. One is post-COVID, as remote working became acceptable, India has become the back office of the world. Earlier it was the coding factory of the world. Today there are 2,000 GCCs in India, employing on an average 1,000 people, employing 2 million people, and that number keeps on growing. So whatever can be done remotely, whether it is accounts, taxation, legal, HR, payroll, content designing, all of that is being done in India, and that number is steadily growing. Let's see how AI impacts that. But I feel that the cost equation, the capabilities what India offers, even if some jobs were to be compromised with, given the young population which should be able to reskill much faster at our price points, cost points, I think this service export should keep on growing. And when you look at the projections of some of these global companies, clearly they are asking for more space and they are budgeting for more headcount. Coming to, actually the service exports has done India extremely good. We were perpetually current account deficit. India was a vulnerable country. We were vulnerable to spike in oil prices. Why? The moment oil prices go up, your current account deficit spikes up, your macro looks weak, and dollars instead of coming in, they start going out, and you are exposed. Well, today India's current account deficit is just 0.5% of GDP. It is one of the lowest that we have experienced, and I think it is here to stay because these non-software service exports are almost 0.7, 0.8% of India's GDP now. It was not enough. India has a second shot at manufacturing now. We missed the opportunity the first time. We were not geared, we did not do enough. And China rightly capitalized on that economy, they executed a lot better. But as someone has said, the seeds of failure, not failure in this context, but directionally the seeds of failure are sown in success. So China has become so successful that their per capita income is today 5x of India. And look at the chart on the top, China is aging now, right? So I think the next 10, 20 years, India has a good chance of improving its share in manufacturing compared to where we are. I would not say we will do better than China. I don't want to compare India with China because they are very different countries. You have many things going for India which you don't have in China. You have many things working in China which you don't have in India. So I prefer to compare India with its own past. And why am I optimistic about manufacturing? So in electronics, India had nothing to start off with. We can make cars, we can make chemicals, we can make textiles, but electronics, India was only importing. The simplest of things. Well, today, in a short period, next year, we hope to assemble with a 20% value addition, almost 25% of Apple phones. We are now India's solar module capacity is surplus or likely to be there. Now we are moving backwards and making cells. So in 3 years' time, we should be surplus even in cells. People talk about a Tesla and a BYD. I would urge you to drive a Mahindra electric car. And it would be 90-95% of what these cars offer you. So if we can overcome our weaknesses and no strengths in these three areas, electronics, solar, and EVs. By the way, Indian two-wheeler companies compete and do better than both the Japanese and the Chinese in many countries in the world. So I think if we are doing so well in our areas of weakness, I feel a lot more confident of being able to compete, of doing better in our areas of traditional strength, which is mechanical things, ice, textiles, so many other manufacturing things. Manufacturing is a very big opportunity, and even a slight progress there can accelerate India's growth rates. So these are two things which have improved incrementally, and these are very big opportunities, and these two, I believe, should increase India's growth rates beyond the 5 to 6% that we have grown for last 30-40 years to currently we are growing between 6 and 7%, and hopefully in the future we could grow between 7 to 8% as well. So let me now look at this chart in the middle. This is the current account deficit of India. Look at the top right-hand side chart. It's a picture we can all be proud of. That's the gap between India minus US 10-year yields. It is at an all-time low. What does that tell you? That the cost of capital in India is converging with the rest of the world. Look at the top left-hand side chart. That's the decadal inflation of India. It has collapsed. So why? Because government has opened up the economy. Every sector is becoming more competitive. There is no shortage of anything. India is an extremely vibrant, competitive economy. The adoption of e-commerce, the adoption of digital, the private equity ecosystem in India is spawning so many new businesses. So and something very remarkable is happening in India. Global companies are now listing in India. They're India arms. Hyundai listed, LG listed, and yesterday Tenneco listed, and many more are in the pipeline. So I think the Indian capital markets have done exceedingly well. They are one of the most liquid markets in the world. almost $5 trillion of market cap. They are extremely liquid, one of the lowest impact costs in the world. So I think the capital markets are also recognizing the bright prospects of the markets. The regulators have done an incredible job of regulating the mutual funds, the capital markets, etc. And what you see here is a result of all of that. India is a democracy, and democracies struggle with fiscal deficits. Look at the state of Europe, look at what is happening in US, and you shudder. Okay, is this what democracy is? Look at India's fiscal deficits. It continues to move lower. So despite challenges of winning elections, India has been fiscally extremely prudent. And despite some of the tax cuts that government has given this year, they are committed to lowering the fiscal deficit. So I think both fiscal and current account deficits in India are steadily moving lower, and that is extremely important to faster growth rates. Let me now come to equities. You all know the journey of Indian equities. Sensex from 100, it's up 800 times in last 46 years. If you work backwards, it will correlate extremely well with the nominal GDP growth of India. I think that trend is here to stay. The only difference is that while real growth rates in India will accelerate, I think they will be. India is, by the way, the fastest growing economy in the world. It should become the third largest economy in the next few years. But I think the inflation in India is sustainably down. What does that imply for stock markets? India does not have non-linear businesses like the US, where profits can grow disproportionately compared to the top line growth. What India lacks is genuine tech innovation, and we have also not been able to create global brands. So what this weakness means is that our profit growth of Indian companies is closely linked to the underlying nominal GDP growth of the country. And because inflation has sustainably moved lower, it means our nominal GDP in local currency terms, despite a higher real growth, should grow around 10-11% a year. And commensurate with that, the cost of capital in India has moved lower. If you look at one more chart, I think it's there somewhere. If you look at the dollar premium, 1 year dollar forward premium, I think it is down to all-time low of about 2 odd percent. Sorry, I don't have that chart. So I think longer term Indian equities should compound around 11-12% in dollar terms. If you can find assets better than that, please go for it. But this is what I believe is a realistic view of India. These returns should translate to a 9-10% dollar return. And the volatility of Indian markets is now extremely low. I am extremely happy to say that while so much attention is focused on, people ask me all the time, when will foreigners come back to India? I am talking of FII flows. And my simple answer to them is, why waste your time? It doesn't matter. Local funds are investing 5 lakh crores a year, 6 lakh crores a year. India's balance sheet is matched now. You are not a dollar deficit country. So if foreigners don't bring in money, economy will still do okay. And capital markets anyway, it makes no difference. India is raising $80 billion of fresh capital a year, 6 lakh crores a year. So that is like someone selling stock, right? It is a promoter, company raising new capital, or a PE selling. So how does it matter if someone else, FPIs come and sell another 50,000 crores? It makes no difference. So I think it's been few years since the local funds have grown to such a size. And by the way, India's pool of savings is one of the largest in the world. $400 billion of financial savings, $800 billion of total savings. The balance is physical savings. And currently only 15% of financial savings is coming to equities. When I started my career, it was 0. We have now come to 15. Globally, that number is between 20 and 40%. So I would not be surprised if this monthly flow, by the way, in 2003, we collected 140 crores in a full year, all the industry put together. Today, almost 40 to 50,000 crores goes into the markets every month. I think in 5 years' time, this number could be 3x. So I think India is becoming like a self-contained economy. Your current account has collapsed. Your current account deficit has collapsed. Your capital markets are attracting local savings. So I would not worry about if foreigners find other markets cheaper, and if they invest there, it's okay. I mean, they are welcome, but I don't think the markets are going to be impacted by foreign outflows. Now, look at these two charts. Last year, India was a serious underperformer, and Indian markets had become pretty expensive more than a year back. We wrote about it in our commentaries as well. And last year, I think India has seen significant underperformance. The good news is that after being flat for 15 months, in a period when markets like China, other EMs have done exceedingly well, India's long-term premium over EMs has come down to near average levels. Also, foreigners have not been net sellers from the numbers what you and I see, because a lot of that money, what they are selling in secondary market, is coming back in the primary markets. So I think going ahead, I feel that with these 15 months of time correction, with Indian markets having withstood 2 or 3 rounds of significant FII selling, with earnings growing, PE multiples have moderated, I feel that Indian markets over next 3, 5, 10 years should give low double-digit returns in local currency terms and a high single-digit return in dollar terms. The return on equity in India is one of the best in the world. Only India and US deliver about 15-16% return on equity. Most other markets are much lower. India has, and I think will continue to trade at a premium to most EMs. There are 4 or 5 reasons for that. One, it is the fastest growing economy by far. Number 2, the volatility of growth is one of the lowest in the world. Number 3, the composition of Indian markets is extremely different. If you are heavy on commodities, your PE multiples will be much lower. If you are heavy on consumer companies, on retail, on software service companies, on pharma generics, which India is, your PE multiples will be much higher, because these are businesses that need much lower capital and the ROCs are fundamentally much higher. So don't compare India's PEs on a headline basis with other markets. Look at the underlying composition. It is a fact that some sectors in India, even if you adjust for the higher growth rates, are very expensive. I feel the consumer companies, the retail companies, and many of the small and mid-cap companies are very expensive in India. So what I am saying about the markets, I would say please apply that to large companies, to Nifty, and not to the broader markets. This has been a narrative-driven market in India last 5 years. Pre-COVID, there were 3 crore demat accounts in India. Today, there are 21 crore demat accounts in India. These 18 crore demat accounts have no memory, no understanding, no experience of markets before COVID. They were fortunate to have participated in the markets post a crisis when small mid caps had collapsed 70-80%, large caps had collapsed 30%, and economic sensitive sectors, which are the PSUs, had collapsed 50-60% also. And because of that very low base, the returns in small mid caps have been much higher than large caps. It would be an error, in my opinion, to extrapolate these. But that is what these 7 out of 10 investors, because they have no experience of prior to 2020, they seem to be doing. I think those expectations are likely to be unmet. This is what I was referring to, the chart in the middle. This is the US dollar premium, 1 year forward premium, and you can see how it has collapsed. So if you are disappointed with the 11-12% Nifty return, translate that to dollar terms. Last 30 years, the 2 best performing markets in the world are US and India. 9 to 10% dollar terms. I think India should still deliver that, though your rupee returns will be much lower. And look at the chart on the top. That is the volatility of Nifty. It has become half in last 15-20 years. Those 2 spikes are around Lehman and COVID. I think next time around, when the next global crisis comes, while stock markets may still see some impact, I think the fall will be much lower because the stocks are moving continuously to stronger hands, to local hands. Let me, I think I have run out of time, but the chart at the bottom, it is very powerful. The dotted line is the profit share of small and medium companies. And the firm line is their market cap share. And you can see how the two have diverged. So this is a very clear indicator that small and mid caps appear to be quite expensive. So I would be quite cautious in that space. I mean, to conclude, I think India will remain the fastest growing economy next 10 years, hopefully longer. And I look forward to the day when storage of energy becomes cheap. And I think that will be the best time for India, because that is when, if a country is large and huge and your current account surplus, that is when purchasing power in India can grow far more rapidly. So I think clearly there is a last 5-year returns have been very high. But that is entirely because of the very low base of the markets post-COVID. It is said that the best investments are made in the worst of times and the biggest mistakes are made in the best of times. So in this market, I think there are many excesses in India, especially in the small mid caps, many new companies going public. I think investors will be disappointed in many, many cases. I don't think they will be disappointed in large caps. But this public markets in India are playing the role of an angel investor, private equity investor, growth investor, early stage investor, all put together. If you are an entrepreneur, if you have a story, public markets will give you money at a very expensive valuation. In 9 out of 10 cases, in 7 out of 10 cases, investors may lose money. But I think India will still win, because even if 1 out of 10 of these entrepreneurs does something wonderful with the capital what they get, I think they will make India's economy bigger, brighter, and it will grow faster, because a country ultimately is as good or as weak as the companies that has. So I feel the amount of startups, the excitement in India, the innovation in India, government support, and the capital which is flowing to all kinds of entrepreneurs, I think bodes extremely well for the economy and capital markets, though I would not say that the experience of investors would be equally good in many of these cases. So let me stop here. Thank you so much. It was a real pleasure being here. Thank you.
Thank you, Prashant. That was truly a masterclass. Your clarity of thought and conviction in India is contagious, to say the least. And you have given the audience a tremendous amount to reflect upon. May I call Anita back to the stage to felicitate Prashant.